Hey everybody, welcome back. Well, we have a lot of conflicting data that's throwing us all around. We're going to drill into it on a more global scale, and then we're going to drill into it and get really actionable here. We're going to start with the basics. So here's the ES S&P futures. On the weekly, we pop over, and then we come down and we encapsulate. Let's take a look at the NQ for a second. You'll see something very similar, but a lot more tragic, right? So this bar completely encapsulates this. Now, we're going to look at a couple indicators of all three major indexes in a second here. But what we want to do is we just want to start with the basics and say, okay, what's going on? Now, Captain Obvious here, obviously money's going in the small caps. We're going to talk about why this is going to continue, which sectors to be looking at. We have to talk about the sectors because they're not what you think. It's really important to dive into that. There's one trade in particular I want to do a walkthrough through as well. But if we just did the basics, we could say S&P doesn't look good, NASDAQ looks awful, and then we could see the RTY is actually becoming the leader. We also have to talk about equal weight versus market cap weight and what's happening there across the indexes, specifically in the SPY. But if we then just dive into something very simple and look at this on a weekly spot, here's on the NASDAQ, and then you jump right into this, and below is rate of change. Now, what I will do here is I'm just going to click this, and I'll make white and bigger so that we can all see it and go from there. But what do we notice here? We're seeing on the weekly that the rate of change is rolling. Now, rate of change is relatively simple. It means the rate of change from a weekly, daily, or hourly chart. Why we focus on it is, if you're negative, you can't go up. It's really that simple. If you ever wanted an indicator that says, well, maybe we're going to bounce here, you can literally look at the rate of change and go, well, is the rate of change going up or down? Well, it's dropping. So what does that mean on a weekly basis? At best, you can hope for some level of stabilization dependent upon the time frame. For example, if you're looking at this on a weekly and you dropped it to something like a daily, then you're going to see that you're essentially falling off a cliff. So the idea of looking at this on a daily chart right now and saying we're going to bounce, sure, but you might want to see if this thing starts pointing up first to see if you're going to have any semblance of a bounce. And this is really simple, guys, to use. I mean, if you just look here and say, oh, well, we turned here and we started to do what? Bounce, gets above the zero line from here, and what's it do from there? Oh, it starts to go higher and push, pulls back under the zero line, over, under, and then what happens? It's not rocket science. It's a real simple way to just say, hey, where are we right now and where's the pressure? This is doing something that should make anybody feel warm and fuzzy. Just FYI, this is a negative divergence. We like positive divergences if we're long. That's a negative one. Now we'll talk about why this is going on, and we can talk about why this is probably going to stop. And we need to talk about the breadth and how it's expanding even while this is going on. And while that's good longer term, there's some different ways to look at the world dependent upon your time frame. But if we took a look at the NQ on the weekly and we said, this is what's going on, let's clean all that off. And then we just did the same with all three indexes just to get a sense of where we're currently at. You would look at the ES and you would see something very similar. Now, does this mean that it's the end of the world when you have a negative divergence? No, usually it means it's got to work itself off. At best, you go sideways for a little bit, but you can have a negative divergence for a very long period of time before it even comes home to roost. And then eventually it'll kick and turn its way around. But when you see them, just pay attention to them. Even here, you could see how you had a positive divergence right here, and then how it reversed back over the zero line, and then it was on right in that November. And now we're just working this one off. Now, whether that leads to a big pullback or a small pullback, we don't know yet. But you take that weekly, and then you drill that weekly into a daily, and you just take a look and go, oh, well, that's kind of interesting. And then you can see the lower highs. And now what are you doing? You've broken the zero line. So from what we know about this, what is the probability of us miraculously going up if the rate of change is negative? Well, we know it's zero. We know that we need this to start pushing higher and turning. So this is rate of change, and this is something that I would suggest you look at. For what purpose? Just to get a sense of the market. If you take a look at RTY, we can see this lifting. We're going to talk about why the breadth is good and why the breadth is bad. And it depends on your time frame, but we're going to get into that. And it's really important to see this because there's an issue, and I'll get to it. But if you look at this right here, you can see how we lifted. All right, great. And then you come here and then say, okay, well, here we are in the weekly, and that's starting to lift. Great. This is not out of hand yet, guys. This is just starting to curl. So you get that 1 in 100 year kind of push that we went over already recently, and now you wind up with this. And there's a lot of once in a lifetime things going on, or once in every 100 years things going on right now. We have to talk about that. It's good and it's bad. I touched base with it on Wednesday, and we'll go from there. Thursday's video, for those that are new, welcome. But Thursday's video was the price action video you asked about. I will link that one and the other price action video. at the end of this video. My goal here is not only to provide excellent information and education, but I think we're doing a pretty good job of getting this across, but also to show you how to do it and make it actionable. You have to focus on your time frame. And understand when we go through all this in the comments, please comment on this, because people are going to say, oh, well, you're contradicting. No, I'm showing you different time frames and I'm showing you what's going to happen or what I think is going to happen. But frankly, nobody ever knows. So if you see here and you see how you're just riding there and you're trying to pop over, look how tight that's getting over and over again. I would be leaning towards small caps. I think it's a question of rates are coming down and now we just have to figure out how to profit from it the most. But overlaying this and then looking here, you could see, yeah, I think we're going to rally, but this is pointing down. So the probability of us going up while this is dropping, it still can, but are we going to have the magnitude moves that we just had in the Russell anytime soon? The answer would be no. You're probably going to pull back a little bit and work it off. And you can see that very clearly. Especially what I really like about this is if you look at this and just look at the peaks of where you're at on it, and you just say, oh, well, that kind of makes sense. You kind of get peaky when this happens, and then you kind of work it off, come back to a zero line, right? Under, oh, okay. So that kind of makes sense on how it works, right? It's not falling apart. It's just telling you that, hey, we're probably not going to have that umph right now because we're heading down. You're still positive, but the movement of this is telling you that it's going to be less. It's very empirical, not really a subjective way to read that. Now, what is subjective is how you look at the Russell. And again, what we're doing is just get a sense of what's going on in the world before we start driving into data sets. This is really important because if we look at the RTY here on the weekly, and you can just see the RSI here, then you pop that onto a daily, you're up and you're over and you're already working off the overbought. And now you're heading back to that neutral. Let's take a look at the NQ for a second and see how that's going. Not going to have time to edit that out. As always, your comments are appreciated. This video is beyond packed, and that's why I'm talking fast, because there's a lot to go over. No one could look at this and feel warm and fuzzy on the NASDAQ. I don't know how you could, but if you look here and you look here and you realize that you have these right higher highs and you have a lower high here and you have a major divergence on this, you got to work it off just like you did here. It doesn't mean you can't go higher just like you did here, but you have to work it off. And eventually you get some level of worked off, and then we kind of go from there and we figure out who we're going to be when we grow up. And that's exactly what's going to happen here. We're going to get some kind of flush, I think, is out there, and go from there. And you can see that again on the weekly, that you're over. Take a look at this on the ES, and you can see that you just broke here and you have a negative divergence on the ES as well. Go look at that on the daily. And there it is again. And you can see how this overlays perfectly with the rate of change. But here you had the higher high, so everything was groovy. 80 is pretty high. You're back to the neutral line. If you break neutral and you go to 30, probably realistic. I don't know many times that it takes months, but I don't know many times when you've done this, where you've had a negative divergence, where you really haven't come back and gotten to that oversold level and watch people puke and think that no one's ever going to buy anything ever again, right? So usually we are creatures of extreme behavior, and I would think that this is no time going to be any different. If you take a look at this again, one final time with just the RTY, please keep this in mind. Now, if we look at this, we can see clearly where the money's going, right? Right. But wait, there's more. And this is something really important. Rolling 30-day correlation between the market cap and the equal weight S&P. Where do you see this? To me, it's staggering. Absolutely glaring, as someone likes to say. And you can see that for years. They go out a decade. Actually, they go out 2 decades. Wow, I'm getting old. And then you can see here, and look at where you're at. Okay. Does that look sustainable? No. And herein becomes the problem. Well, problem number one. Going through that, and we went through it fast, so you can always go back and look at that again. You can see very clearly that rate of change is negative. You can see very clearly that we're still on the indexes, depending upon your time frame, having negative divergences, and we're still heading down and getting to working off those overbought levels and getting to neutral, or frankly, we need to get to oversold usually. This is RSP on a weekly chart, and this is RSP, and then the other line is going to be the SPY. And market weight, people would say, oh, it always goes that way. And now, let me just show you this. It doesn't always go that way, because if you go back to the beginning of time, these things were pretty darn close together. Yeah, you have your disparities, but what you can see here is that on a market cap weight, it changes. Now, what you've had here, if you look at time, is one of the greatest disparities that you've ever had ever between these two. And this is market weight, right, versus equal weight. And this just shows, this makes sense. We've had 7 names that are just rocking and rolling, but it's causing an issue, and that issue is probably coming home to roost by the looks of it. So then we would look at this on a daily and go, okay, well, that makes sense. And we can see that this is what's been going on since what? Let's go to November when Itchy came out and said that he's not going to cut rates anymore. And we can see how that plays out. All right, so now the SPY's here and RSP's here. And we can say, well, that still makes a little sense because they're buying the big dogs. Okay, let's take a look at this on an hourly, and let's get rid of the pre and the post. And let's just go back to May for a second so that you can see this and start seeing what starts to happen here. So it's just so you see the pulling away of May and how that starts to play out, right? All right, so now you can see that. Now let's go to a key event day. Now, a key event day would be something like the 11th when CPI came out, right? And we're going to go back to this day and look at the sectors from that day in a little bit in this video, but we're going to get through this first because there's a lot to get through here. So first thing, looking at this, what are we saying? We're seeing a massive divergence. Now you see how the S&P was coming down. You can see how the S&P was coming down. At the same time, RSP was going higher. They were selling the big dogs and they were buying these. Right? They were selling the big dogs and they were buying everything else. And then all of a sudden by Thursday, we just kind of said, you know what? We're not going to do that anymore. We're going to just sell everything. And that's what started to happen from Thursday morning on. Now there's a reason for that, and we're getting there, and we're going to go broad in this video. We're not going deep. So I'm going to go through a lot of concepts here that I think are very important, and I'm going to pack it in as much as I can, but we're going broad. And then in the videos during the week, we go deep. But understand that. So I'm going to leave these in here so you can follow them yourself. And you can follow these on TradingView, and other platforms have it as well. I don't care which one you use. But this is percentage of stocks above key levels. And this is really important. So what happens when everyone bought the RSP was we got overbought. And this is where, depending on your time frame, it's a little scary. And I want to get through this before I start going to the other stuff. And people say, but you said, just pay attention, please, and pay attention to this part. Okay, so this is 90, 5 days, percentage of over the 5 days. Every time you're at 90, you get a small pullback. The magnitude of that pullback, we don't know, but 90 on here is usually a pullback. These start getting into the 20s and the 50s. The 50s are what institutions watch. If you have access to institutional research, they're always talking about the 50-day and the percentage and where you're at. Anything over 75 starts getting a little frothy, and you can see that that's usually a level where people will start to panic. And if you mark your charts by these levels, you'll start to see some weakness across the board. What's happened is as they bought the RSP and bought more names, we started to get frothy and overbought on all the other sectors. And so while the other names are dropping down, these other names, the equal weights, now got frothy. And so that makes us extremely vulnerable to pullbacks because now people own those names and they just recently bought them. It's not like they've been in them for a long period of time. They just bought them. So if they start hitting their break evens, they start turning into losses, what do? Well, you close your losers. So if you're overbought across the board with all your new equal weight trades, are you going to hold them or not? No. This makes the market extremely vulnerable here for the short term. Now, this week I will spend more time on smart money, dumb money, but there's 2 points that I need to make so that you are prepped and understand where we are. From my perspective, understanding that when we're low here and we're going higher, what tends to happen? Okay, that tends to mark a bottom. You need to go higher and then the lower. In other words, and we don't refer to this as smart money, dumb money. We refer to this as institutions and retail because of how it's calculated. So what we really want to focus on are those times when this is down below the red line and it's pushing higher. Below the red line and it's pushing higher. You can see it over and over again. I mean, you can set your watch to it. It's pretty obvious. Why is this? Because smart money institutions take their time, and retail, i.e. us, are like a cat on a hot tin roof. I don't know if people say that anymore, but I'm bringing it back. Now, if we spend another second and just look at the breakdown of that, again, institutions versus retail, and we look at this over a 3-year chart, and red is what? And blue is institutions. So what's happening here? Well, every time we peak out, we drop. Is that true? No, it's not. We can peak out, retail can peak out, and we can still go higher. We can peak out, and they can still go higher. Okay, you can see that. Why is that? It depends on how fast institutions are going to buy. If institutions are going to buy super fast, then we can still go higher. If institutions are going to lollygag, do the kids still say that? Then no, you're going to take your time and then the market can come down. So the idea of looking at the spread of this makes more sense. And I would say right now that spread is neutral at best. And retail's basically, when you see this, it's telling you retail's at a bullet. The question is, how fast does institutions reload or don't reload? That's really the question. And that's why that graph is so important. Now I'm going to introduce some concepts and then I will go over them in the week. I'll go over them in greater. But this is one of the most overbought markets since 1920. And you can see relative strength index above 70 in every single time frame. So in every single time frame, look at what you're saying. Daily, weekly, monthly, quarterly, year. It's important to note this stuff, guys. And then go, okay, well, how often does this happen? 1% of the time. How's that usually work out? So is this becoming the year of the small caps? That's something we're going to have to take a look at. Not in this video, but be aware of this. Okay, this is where you're at, and you're seeing us work it off. So this boils down to your time frame. I'm going to tie this all together. This is really important to get because a lot of people are not understanding what's happening. You have a change in monetary and fiscal policy. Okay, people will say, oh, you're red, you're blue. No, I'm green. So in other words, all I'm trying to do with these videos is figure out what's going to happen with fiscal and monetary policy so I can go forward and profit from it. It's that simple. If he takes this stance, it's bad for global and it's good for domestic. So if this is a stance that gets implemented, and this creates what? Massive uncertainty. Massive uncertainty, and we're seeing that. But that uncertainty is on both sides, and that's what we have to understand. We need this uncertainty to go away. So NVIDIA, with the current administration, was told, don't sell to China with these specs. China creates another chip, and then the current administration comes out and says, well, we might not even want you to do any business there, and we might change this chip. Now imagine spending billions and billions of dollars to build something, and then you're being told no every time you go ahead, and you're not being given clear instruction. But all this is doing is creating massive uncertainty around semiconductors. And you're going to have this uncertainty and this level of volatility until we get a clear, definitive area of what can and cannot be done. My personal opinion is trying to hold something back never ever works. Trying to hold back knowledge or technology, it never works. You're better off just being better. I mean, it's really that simple. And I want to point this out because you're talking about semiconductors are going to just implode, and this is one of the worst markets ever, and we're completely overbought. And then I have the NASDAQ Zweig breath thrust that's firing off here, which consistently leads to 1 year later and then at 100% win rate, okay? So we're going to get into this as the week goes on, but understand all these different indicators are firing at once. So what does all this mean? It means understand your time frame. If you're day trading, day trade. If you're swing trading, swing trade. Understand the environment you're in and understand if it's a tough penny environment or it's an easy penny environment. If you were to look at something like, and this is the best way I can explain it, let's look at Microsoft, and you look at Microsoft on a daily chart. Somebody had a really good day here, someone had a really bad day, right? The person that's owned it for a year, they've done really well. When people say, oh, when's the best time to sell Microsoft? I always show them this chart, and I say, you tell me when was the best time to sell Microsoft. In someone's minds, the best time is when? Never, right? I mean, clearly, if you were to hold that, you did exceptionally well. Oh, well, this time it's different. Okay. But what we have to do is look at this and say, well, what am I trying to do? Am I trying to make money off an options trade? Am I trying to make money off a day trade? What am I trying to do? What I would say that you do with every single thing that I just went over is review it again. And I went broad because of what we're doing, and we're about to go a little deeper, but I think it's really important to get this concept. Because when you're looking at this, this was just a straight out victory on Friday. We did this trade and we did exceptionally well with it. I'm going to walk you through it. But you have to understand, what is your time frame? You want my opinion, which I'm going to give, and it's an opinion, and like that, it's worth about as much as everyone else's opinion. I think you're setting up for a pullback, and then I think you're setting up to push later. I think that that's where this is going. But I think you have to implement different trading styles through all this. Take a look at this, and then we'll go forward, and I'll show you what sectors you need to be looking at going into next week. Now, if you've been watching these videos for a while, you know I'm a huge proponent of trading journals. And to me, it doesn't really matter which one you use. Let's get this little arrow here for a moment. Let's just review this really quick so you know what you're looking at, and then I just want to point out the obvious. So here's January 1st. Here's where you're at. This account started with $1.60. Every year, what I'm going to do, I asked for comments on it. I'm just going to reset the account back to 100 every year, and then I'll just run the account. I think that's the best way to do this. Trade expectancy right now, 224.02. This is really important because it means every time that you touch the computer, you know exactly how much that you're going to make. Profit factor, 163. I'd like that to be greater than it is. I'd like to get it as close to 2 as possible. And the win ratio, this is really important for people to get, 53.88. That's a really good win ratio, guys. So a lot of people keep hearing the 70, 80s, as people, as I always want to say. Go ask if they've ever been audited, because it's just not realistic. You can do it for a period of time, but you're not going to do it for anything more than, a very specific period of time. Remember, the big guys like Simmons, Cohen, Simmons was 51%, and the guy was one of the wealthiest hedge fund managers in the world. I think Cohen is like 54, 55, something like that. And Cohen's best trader on his desk, I think he's like a 9-figure earner, and I think he's at like 62%, which is absolutely insane. 139, and I'd like to get that closer, but now this tells you where you're at. I have a drop right here. That's actually a NVIDIA split. It's actually not that bad, but it's reflected right there, and then you can see how it just starts to lift again, but you have your ups and downs. And so when we have a baseline and a body of work, then we can drill into that and look at very specific times. But let me show you what I mean by that. Now, we're going to get to the Microsoft in a second, but comparative analysis is extremely helpful. So if you have a baseline, and let's say that this is our body of work for this one account. Remember, when I talk about this account, this is what I refer to as a running gun account. It's a very aggressive account. Day trading, options, short-term swing trading, and I link it to what I do in the Alpha Chasers community. Some of those trades in that community are much longer term, but this focuses on those shorter term trades. You're going to have ebbs and flows like any style of trading. And again, before I go to the next part of this, what you want to just remember is that this is here just standing there because of the split. But what I would do if I look at the entire body of work is then say, okay, this is where I'm at. What's the real issue? Well, the issue is the 139. And what you can see from here is going forward, just even looking at this, you can see some of these anomalies hit. Some of them are offset because of where they were, like from the night before, just the way the pricing works. They're not as extreme as they look. But you can start seeing that it's starting to become a tough penny environment. Matter of fact, like one of the worst starts was just really what happened. So I'll walk through that in a minute, because I think that's really important for people to get. This idea that everything just miraculously works out every day, and you're just swimming in your pool, high-fiving your bros. It's just not realistic. So what we would do here is let's go to January, and then let's go to March 31st and see what that gets us. That's going to get us this anomaly that's in here, but you can see it's not as great as that. But what this will show us is, okay, so the win rate for the first quarter was down. The trade expectancy was 240, but the profit factor was 183. And then you would take a look at next quarter. So you're comparing not only month to month, but you're comparing quarter to quarter. In other words, if my trade expectancy is here, and then you have 3 months, and so you can figure out what you're making per month. But then you go here and you go, okay, well, 52, all right, that's not bad, but it's on the low end of where the year-to-date was, right? Now, this is where data sets, to me, get super interesting, because you can see that we're taking in the next 3 months, and even including July, and what you're seeing is where you're at, which is not as great as where you were the first 3 months. Trade expectancy is dropping, profit factor is dropping, average win-loss is dropping, and the win rate's going up. So if you're looking at this body of work and you're doing this quarterly, what's really cool about this is then you would know, okay, we're in a tougher penny environment, and when things are going my way, I need to move faster. I need to lock things in. The whole purpose of data sets is to create action and to create a plan. So when I start to see this, it lets me know the idea of building and holding things right now versus first quarter is probably not optimal, and moving faster and locking in profits is probably more optimal. This kind of knowledge lets us act differently in our day-to-day trading, and we're getting there. Now, this is why it's helpful. You can see what I'm up. You can see that my trade expectancy when I touch the computer for this last 30 days is down. And I guess a lot of people aren't going to show this, but it's important for you to get this. Even there, I clawed back and we're up. And now how do you do that? You got to realize that I'm fine, and then I walk into a gap down. And when you walk into a gap down, it is what it is. You have risk. Every time you hold stuff overnight, you have risk. So you have to look at this and go, okay, well, what's going on? All right, this is a really tough penny environment. And the one thing about consistent trading, I should do a video on this, walking someone through this. Like I literally worked with someone for over a year, and when I had their data set, you could see how they progressed. But it's the consistency of this. Because if you're doing the same thing over and over and over again, then when you start to see this and you have the gap down, you're like, okay, well, that's awful. It wasn't fun. But what that does do for you is that you're like, okay, well, this is the kind of environment I'm in right now, and this is what I'm going to have to do. I'm going to have to fight back. Now, you put your plan in place, you implement your plan, and you go from there. And I think that's a really important thing, because the idea that you're going to be trading tech stocks, this is a run and gun account, as I stated, you're going to be trading tech stocks, and miraculously, you're not going to ever have a bad day or two. It's just nonsense. And I think that people need to be more open about this when it happens. It's no big deal. It's a drawdown. It's part of the business. Let's get to the Microsoft trade, and then you can start seeing why, with all this data we just walked through, I executed it the way that I did. Now, this is the trade that we did, and what we were doing is we were just watching the news. So Microsoft comes out and says that they have a glitch, but it's really not them, it's somebody else. It's like a relationship, right? It's not you, it's me. But they just did the inverse of that. But and what you're seeing here, 930, 931, 932, and then we're seeing signs. Now, I tend to do this. If I want to have a larger position in something, and this is what I would say about this environment, this is why I showed all that data. You're in what I refer to as a tough penny environment where you can have gap up and gap downs, and we're going to see some of that in some more of these charts in a moment, what you should be doing and how you should be reflective on what's going on out there. But if you're going to have gap up, gap downs, you're going to have more inherent risk. When you have edge in this market, less trades and press those trades. Less trades, not more trades, less trades, and you press those trades. So here you can see, I think we bought a couple thousand shares, but what I'm doing in here is I'm firing in. Oh, it worked? I'm firing in. Oh, I'm up a decent amount, I'm pulling a chunk out. Oh, it moved, it hit a new high, I'm pulling more out. Oh, it looks like it's going down, I'm pulling more out. I'm not playing games. Oh, you popped, you hit a new high, I'm pulling more out. There's no, this is going to the moon, there's no high five in the bros, right? And then what we did was this get right back to the gap fill, and you're going to see this play out live in 1 minute here. But what I'm doing up here, oh, you're up? Okay, you hit, I sold some. Okay, you dropped lower than my first sell. Okay, I'm out. Here, watch this play out live.
The other side of that is Microsoft. Like, how ugly is Microsoft going to get, right? Like, that's a pretty big drop for Microsoft. You might see people step up and go, okay, well, it's Microsoft. Is that really going to continue like that? And I am going to buy some Microsoft here. I bought a bunch of Microsoft. I mean, worst case scenario is that low from there. It's going to cost me $3. I mean, I could wind up finishing flat on the day. Up $1. If you did that for a day trade, you should already be pulling money out. I did it one of the accounts for a day trade, and right into that, I'm pulling money out of it, and now I'm just going to hold the rest for a little bit and see how it goes. Now, when you start moving up there, you have to realize that if you're doing this for a trade, you're going to have to start pulling money out on the way up. I would definitely tell you that you should be pulling, money out of that as it does that, as on the day trading side. Okay? Like, I would not even be thinking about that on the day trading side. And then the other side of this too now, guys, is if you're trying to play it like close to the vest and you don't want to lose money, the rest would just be at break even. That's how I would do that trade now. So the easy money there has been made on that Microsoft call. You can just see how it's acting. I wouldn't go past break even at this point with it and then just leave it alone. Maybe you get the gap fill, maybe you don't. That's just a monster. Good. That's our level. That's what we're looking for. All right, I'm at break even, and we paid $4.34 for that, and now we're at 4 there. And goodbye. Okay. If you day traded it, I am 100% out of the day trade. I'm not saying this can't go higher. If you're doing it for a swing trade, great, stay in there. If you did it for a day trade, you nailed it. Like we nailed it. We're in from here. We wanted the gap fill. We got it.
Now, I hope you found that helpful. And if you want to see more content like that, please comment below. Your comments are how I create content. It's that simple. If we look at something like Microsoft back, oh, that was a great trade. And so it's not a question of, is that a great trade? That's great. The question is the process. Once you have all your data in a trading journal, you can start looking at your process. I don't care if you're doing it in Excel. I use TradeZilla. I have no affiliation with them. I purposely don't use affiliation so that I can just use whatever I want. But I think that you should look at a trading journal. And there's several, Traders Inc., TraderView, and I know guys that create their own Excel, and maybe that's even better. I used to do that, and it just depends on what works. But if we look at Microsoft, and let's pop this up here. I did this really weird thing on the computer. I don't know how I did it. All my buttons inversed. So if somebody knows how I did that, please comment below, because it's maddening. It used to be with the numerics over here, and now this is what I have. All right, let's get back to the video, and you're just going to have to bear with me. But what I really want to focus on is understanding the environment that you're in. And once you understand that environment, you can kind of go from there. I think our time is better spent looking at what the heck is going on under the hood right now. So there's no better way to do that, in my opinion, than to take a break and just look at the sectors for a second and then drill into the sectors. We go over all this data, which is very, very helpful to go over all this data and look at what's going on in the world. But the bottom line is understanding how that data is really affecting the charts. You can look at it, but you still want to see how the engine works, right? You can look at all the pieces of it, but you have to really look at how it works. So if I'm looking at something like Microsoft, for example, and we realize we're coming into earnings right here, okay, coming out. And I think this is a really important point. And if you take another data point from this, and there's already been a ton of them, if you take another data point, understand that the buybacks are going to start kicking again right around the 29th. Right? So this is what happened to the market last time when the buybacks dried up. And then when the buybacks started kicking in again, it worked. Now, it's not a question of are the buybacks there for Microsoft, but they do take supply out of the market. I would be using a very simple suggestion right here. I use a 12, a 22, and a 55. I would use what you're comfortable with. But when you look at stocks, understand where your demarcation lines are. And that's how I use these, because these are a lagging indicator. And what I do here is I would just look at this and go, okay, well, the 12 and the 22, this tells me on the 12, this tells me, is this a trade that I would want to swing trade right now? And if I broke this, this would tell me that the probability of a swing trade is less. Okay, that's how I use the 12. Anytime I'm over the 12, I have a higher degree of probability. Then I would look at, some people use a 9, a 5. You should use what works for you. Now I have a 22. The 22 tells me who's in charge. Are the bulls in charge or the bears in charge? That's how I use a 22. I use these as demarcation lines. I don't use them as just art on a chart. I made another rhyme. And the 55 to me is institutions. I use the 55 for a lot of different reasons. I'm not going to get into it all now. If you want to use the 50, go for it. You could see that the 55 held and you open there and you're holding. Now, does that hold? Does this eventually come down and swoop and give us something to work with? Now, I don't know that it does. I also don't know that it doesn't. But what I would do is I would pay attention to it. In other words, what we're always looking for is we're just looking for that edge. So does this kind of just come down over time and then, start going back up after it comes down and rebuilds? Maybe it does do that. Maybe it doesn't. Right now I'm holding the 55. So if I start looking at the big dogs like Microsoft or Apple, and I see what's happening, for example, even here, I'm trying to rally and I can't. I have to respect that these are control bars. These are major control bars. And control bars, to me, you guys should know that I pay very close attention to what I refer to as a control bar. You could think about them as 2 times ATR, average true range, which is a feature in indicators. But we're not going to go down that road. What we're going to do is take a look at what's going on with the big dogs. So if we look at the big dogs, they're not rallying. As much as I want NVIDIA to rally, right? As much as I keep telling people NVIDIA is going to be the biggest company in the world, and I still believe that it will be. I have to look at this chart right now and say, control bar, tried to rally, smacked, completely matumboed, formed what? Bullish Harami here, broke the 12, the 22, smashed, gap down. Remember that loss that I took? That was me in tears right here. All my hopes and dreams, right? And so when I look at stuff like this, and losses, guys, they're just, it's part of the game. If a drawdown is going to get you out of the game, just stop now, because everyone's going to have them. So anyway, if you look at here right now, am I going to hold there? I don't have a clue. The only thing that bothers me about NVIDIA is this. I'll show you this, and I'm going somewhere with this, so stay with me. So if you see this wicks are what? Price rejection. Well, what happened on Friday? Well, we're not rejecting there anymore. So what does that tell me? That tells me that the people that were buying in here and cleaning out the sellers, they're gone. And so then I would go, okay, well, that's going to be a pickle. Another thing that I would do is start looking at the sectors themselves. For example, how does the SOX do when it breaks the 55 and I lose institutional support? And so what I find helpful, this is another exercise that I would suggest that you consider doing, is just looking at this with just one line on the chart and go, what happens when we lose institutional support? And we already know that we have where the smart money is, where the dumb money is, where retail and institutionals are. We already know that we're overbought. We've already seen all that. So we already know where we are. So which way is the pressure going to go? Up or down? But look at what happens when you flip this. And if you just used it from that perspective, right? And said, oh, it broke, I'm going to stay out of the way. Oh, it's back above it, I'm going to get back in semis. We tried to break it, we couldn't. Oh, we're back above, I'm going to get involved. And I don't use the slope right away to determine that because it's a 55. I mean, by the time I'm waiting for this to slope up, right? I'm up here. That doesn't make me feel warm and fuzzy. I'm going to be down here. I'm going to have to take risk. And of course, the more risk you take, the higher the reward. I would argue you have less risk here than you do here, but another time on that. But you can see here, we cracked. Okay, so if we're cracking there, and that's the leader, then I have to go to the next leader, which has been XLF, and say, all right, how do we look here? Okay, well, the institutions are holding there. Great. And then I have to go here and take a look at the XLF and say, all right, where are we going to hold? Can we hold here? And then do the simplest things. Now, why am I showing those two indexes or those two sectors? You never, please listen to the words because I'm choosing them for a very specific reason. You never have a sustainable bull market without financials or without the semiconductor index. It just does not exist throughout history. The only time you can get a good solid year out of it is XLA. That's the only time. Sometimes you can get a good solid year out of XLA on a move there, and that is starting to pop. And we have to think about, is domestic policy going to change? Because if domestic policy changes with the current administration or the new administration, then that could lead to some kind of inflation, which is why you're seeing the dollar go up, why Bitcoin's going up, why energy is going to wind up going higher, right? So when you start to see these things, you might want to pay attention to energy. But at the same time, it didn't matter on Friday. They sold everything. So what does that tell you? That lets me know that they're getting out, right? So, okay, so stay with me. We're going to get there. So then I look at XLV and I go and say, all right, well, are they buying the defensive names? Well, they're buying XLV. And then I would say, well, if they're buying XLV, they must be buying XLP because that's another defensive name. And you'd be like, no, we sold there. And this is where it gets super interesting because then you go look at IHI. Now, IHI is a medical device group. I think they're going into subsectors with cash flow. And I'll show you how I'm arriving at this. But you can see how this broke, and then on Friday, this is up. What I would do if I was an investor or a trader is I would be running through all the subsectors. I have 40 of them that I look at, and I would determine which ones are up or down, and there's a great way to do this. So in front of you is 40 sectors, including indexes. And I can make this a little cleaner, but what we did to start is we just went back directly to the sector list. And all we do is zero out from this date. And now this date, actually make this a different color. Let's make it white. It probably stands up better as white, right? I think it does. So we'll leave that as white. And that way you can see, you can't really see it in here as much, but you really want to see the end result. And what we're doing is going, okay, on the year, what's been killing it? All right, well, these Bitcoin names are outperforming everything, and they're outperforming the stocks, they outperform gold, XLC, and the NASDAQ. This is where it gets interesting. The NASDAQ is doing better than all of this just by buying the Qs. You're outperforming everything just by buying the Qs. The only thing that's not outperforming is XLC, gold, the stocks, and the Bitcoin names. It's pretty fascinating stuff. But now what you do with this data is you drill in to very specific points in time. What's a really close, specific point of time that just happened. Now I want to show you the significance of this event because this is really important. This is the 11th, and the 11th was CPI. And this is exactly what happened. This is exactly where we saw CPI come out, and we saw a negative rate on CPI, which is something we haven't seen since the pandemic. And I want you to just take a note on the amount of volatility that, pardon my voice, the amount of volatility that has happened since that date. And I'm not gonna have time to edit this out, but you see how tight everything was? See how wild everything's getting? Do you think this should make you want to hold stocks for longer or think you want to hold stocks for shorter? This is another data point. Just like when we were doing the trading, during the trading journal, it's another data point. Things are getting what? Wild. Does that make people feel comfortable or does that scare the bejesus out of people? It scares the bejesus out of people. I don't know if people still say that, but now they do. I'm bringing it back. So we have where we were year to date, and we can go back and we can look at that year to date shot, and we can actually even throw that on another screen and look at it. But there's one thing that we cannot deny. You can go here and look at ITB. Now, I set this up, the way I have this set up is I list them all so I can see, and I could take one out or I could put one in. So for example, if I wanted to go, well, what's this one down here because it gets cut off sometimes, I already know what it is, spoiler alert, but it's the socks. But I could just go here and hide it, right, if I wanted to and put it back on. It just makes my life easier if I want to take out data points. But what I would say in looking at this data, you should see a major shift here, like massive shift, you should be saying. And you're like, well, please point it out. I'm glad you asked. So here you are again. Well, what's going on? Home builders and then home builders. Home builders are going to go through the roof. And there's a lot of reasons why home builders are going to continue to push. Most important is mortgage rates are going to come down. A lot of people are talking about not if rates are going to drop, but how much and how fast. So no matter who is elected, and we have to pay attention to that because of monetary and fiscal policy, right? Everyone says, oh, I'm red, I'm blue, I'm green. The whole purpose of this is how do we make money? So if you look at this, just go 14% and realize, wow, I'm up 14% from these dates. Like that's huge. And then what do they do with semiconductors? Well, they can't get out of them fast enough. They literally cannot move fast enough. There's got to be a way to fix that. I'll do it later. I'm not going to do it now. I want to get rid of that background there. They can't get out fast enough. All right, so then we go and take a look and go, well, what's next? Well, BLOK. All right, so let's get this straight. So the BLOK names, it doesn't matter what's going on, where we are, year to date or now, they're pushing. So what names do you think you should be looking at for short-term trades? Even though I'm not really a fan of them, it doesn't really matter what I like, right? It matters what's working. So looking at the block names, which would tell us that we have to look at, looking at the home builders, it would tell us we have to look at, looking at the oil export or exploration names we have to look at, and then you have IWM. And then you're going to take a step back and go, let me get this straight. IWM is outperforming 37 different sectors. So if I just buy the small cap index, I'm outperforming 37 different sectors. That's huge. Because if you start to go through this and look, in this range, you don't see anything. You don't have anything else like that. There's no other real index that's doing that. That's really important. So then you would go, okay, well, they must be buying defensive names. And then you start seeing where the defensive names are and realizing well, they're right down here. And then you start realizing, well, that's not really what they're doing either. So what we're seeing is just a good old-fashioned rotation. Now, if we look at something like this, pardon me, if we look at something like this, we could go, all right, well, I understand this, but semis are going to come back and AI is going to rule the world. And yeah, I get all that. And I understand that. And you're talking to somebody that's long a lot of semiconductors. And as I've stated several times, I compartmentalize my trading accounts, meaning the one that I showed earlier, that's how I day trade run and gun. If you're looking at swing trading, it's one thing. If you're looking at day trading, it's another thing. If you're trying to figure out the inflows and outflows of money, why wouldn't you want to stack the deck to the most in your favor? Meaning, if I'm betting against semi or if I'm trading semis to the long side, which I am doing right now, I have to realize I'm fighting an uphill battle. But what we've been doing while we're doing some of that is we're changing what we're looking at. So in other words, I've been focused all week on trading some of these other names, but I've also been building positions in them, such as the nail trade. That's really working very well. Like this has just been on fire. Now, why is that? Well, here's ITB. We're going to get to it in a second. These kinds of names like nail, DPST, the regional banks, like these kinds of names, they're just going to go higher. It's just a matter of time. Now, is the 3X going to take you there or not? I don't know. Is TNA the way to go? That's up to everyone to make these decisions for themselves. I just provide information, education, and hopefully you're starting to learn what it takes to be truly successful at trading. It's not easy. I always tell people this when they see an 8-figure and 9-figure trader, please remember there's less 8-figure and 9-figure traders than there are professional sports athletes in the world. So if you start to take a look at something like TNA and the pop over and the pull back, is that where you want to go? I would suggest that you're better off looking at individual names, but this is definitely something that I've been doing and it's been working quite well, trading those 3 that I just went over. But you have to trade them because they're 3X ETFs, and we all know how 3X ETFs end. They end in tiers. But let's get to the sectors. So we saw the 3 top sectors. So we would go here and look at them and say, okay, these are the names that if I wanted to know where the money's going, then I would start looking at these names, DHI, Linear, NVR. NVR is actually, if I'll just tell you right now, it's my favorite. A lot of people won't trade it because they need to split, but they're not going to. I'll show you it in a second, but that's always been my favorite name because it's really undervalued in regards to the others, but here, I'll show you it. It's just super expensive, so most people won't play with it. But if you go and take a look at their earnings and what they make versus other companies, it's absolutely insane the amount of money that they make on a percentage basis versus looking at like a DHI or going to look at some of these other names that look like they're going to go to the moon. 210 target on this the other day by a firm. Look at Toll Brothers. I mean, these things just look like absolute monsters. And then you go and take a look at when that happened, right? It happened on CPI. So there's a real big shift that happened after CPI, and we can see that in the names. Linear, right? KBH, And these are names that I would sit there and look at, and you could look at them or you can play them. But again, it's the themes. If you go to something like Block and we look at this, and I'm not saying that there's not going to be other names that you could be playing, but if you're going to take a look at the Core Scientific, this Galaxy Digital, which is obviously not US, but MicroStrategy's Coin, you can always play the ETFs themselves, HUT, Mara, Hood, Square, CLSK, and use it here, which I didn't even think about, candidly. But now go look at these charts. All right, so now if we take that data and then go, okay, well, these are the two that stood out to me, like, that's a monster. And I could say anything I want about it. It shouldn't be here. It shouldn't be doing this, right? The what, who, when, the stool. But when you look at that chart, how can you not have an interest in that and saying, okay, well, wait a minute, we pulled back, then we hit a high, then we pulled back, and now we're here. So I can do one of two things. I could say this shouldn't be happening, or I could make money. I'll make money. And so then what you do is you take a look at something like this, you drill into it, and you come up with a game plan and say, oh, well, you broke out of the DTL on above average volume. Or I could just argue that it's overvalued. One makes you money and the other one does not. And it doesn't mean the trade's going to work, but hopefully you see the methodology. Remember, I'm top down on everything that I do. If you take a look at MSTR, it's already broken out. And you would say, well, how can you think that? Well, up, down, up, down. Look how tight it's getting. Look where it closed, right? And I do look at this specific, but this is a Marabuza White. I mean, you don't even have a shadow on that bar. It's straight buying all day. It's just literally straight buying. It's absolutely crazy. No give back. Look at the volume on the bar and realize that besides in here, it's one of the highest volumes of the year. And so you start looking at these names going, oh, okay. Now, some of these don't look as great, right? CLSK doesn't look as great. Mara doesn't look as great. So I do think it's helpful to zoom in on some of these and see where the money's going. And this is what I'm trying to do. I'm trying to get specific. See, how I look at everything is index, then I look at sector, right? And then I look at stock. And this helps me determine not only the day trades and the aggressive trades, where you're running and gunning, but also where do you want to be putting money long term? And then you look at OIH and anything that was green on Friday, you need to be paying attention to. And then you get the SLBs, the Baker Hughes, the Halliburtons, Weatherfords of the world. You start getting these names, you might want to pay attention to this because it's telling you, where the money's going. It's going into exploration. And you look at some of these names and do they look great? No, they don't look great. They look okay, but they're oil names. Like you're not expecting them to run away. Matter of fact, Halliburton actually had earnings and then everybody thought they were going to be really bad and then it tried to rally over the 55 and it didn't, so I just avoided it. But by looking at this and understanding the environment you're in, you can do a couple things. You can look at the SPY and say, oh, I'm not going to participate because, this is what's going on. Or you could follow the money. But you have to understand where you are. And then I'll show you what I mean by this. So hopefully you'll get this concept. If you look at the 12 and I look at the 22 and I look at the 55, I have to ask myself an honest question. Do I want to trade or swing trade things that are in this? Well, I'm fighting the trend right now if I swing trade it. Okay, who's in charge of the S&P right now? Well, the bears are in charge. Okay, demarcation lines, 12, 22, 55. You should use what you're comfortable with. All right, so now I know that the bears are in charge and it's not great for swing trading. Do I want to do that? See where I'm going with this? Then you go look at the Qs. And I'll clean all this off. And then you can say, oh, okay, well, here's the 12 and we gap down, right? And this is, if someone said they're trading tech and they didn't have a drawdown or a gap fill, or I'd love to know how you did it. But if you see here, 1, 2, 3, okay? So I can't break above the 22. Maybe I bounce back up, maybe I don't. But for right now, we have to say swing trades, not the greatest idea in there. Okay, well, now the bears are in charge. Okay. And now the 55 needs to hold. So I still have institutional support for now. Maybe I should be a little cautious. Well, let's go take a look at the IWM. Oh, here's the 12, here's the 22, and the 55. And then you go back and look at this and go, oh, okay, well, all the names I just showed you and all the sectors I just showed you are small and medium cap names. So that kind of ties in. So then you'd start saying, oh, well, that means that's why home builders or these smaller Bitcoin names, they all make sense because the money's going into the smaller mid-cap kind of names, right? I mean, no one's going to look at Meta and think the money's going into there. No one's going to think even though you bounced, you're not going to look at it that way. You're not going to think that they're rushing into Microsoft here, right? Maybe it holds, maybe it doesn't. Okay. The last time I did that was an all-time high close. Wow. But look at this. You can see where the money's going. All right. So, and I'm not saying there's not going to be opportunity. There is. There's going to be tons of opportunity to trade other names. This is one we actually did in the community the same day we did the Microsoft one. And it did well. It rallied and everything else. Now, they have a lot of issues that they're going to have to address, frankly, in my opinion, because I think they're going to have some real issues here. I'm not going to go down the whole rabbit hole right now, but I think they have some real issues and they could be facing lawsuits and all kinds of stuff. But anyway, this was something that you could trade. Now, does this fit the criteria of what I just went over? No. But it depends on your time frame. If you're day trading, this was a monster day trade. If you're trying to swing trade this, do you want to be swing trading something that is not in an optimal sector and not in an optimal index at this time? Probably not. That's it.